Hi everyone, welcome to this session of the Tiger Academy, US Stock Financial Statements for Beginners. In the last lesson, we learned about horizontal and vertical comparison of valuations. After determining a company's current valuation, you know that you should compare it not only with historical data, but also with that of its competitors within the same industry. However, many investors run into this problem. The valuation of a company is already high, but regardless of the horizontal to vertical ratio, they still feel it's a good investment. Should they go ahead and buy the stock of such a company anyway? Or maybe it's a good company, but its stock price has been beaten down. Isn't buying an undervalued stock a smart thing to do? In this lesson, I'm going to teach you the third trick for trading stocks, the Davis double play and the Davis double killing. After learning about these terms, those questions will be answered. First of all, what is a Davis double play? Here's a brief history of the Davis family. Davis was born into a middle-class family in 1909 and later married Catherine, the daughter of a wealthy businessman. Using Catherine's $50,000 dowry, he turned it into a fortune of $900 million by the time he passed away at the age of 85. Over 47 years, the average return on his investments was a whopping 23.18% a year. And it wasn't only the first generation of Davis family that did well in the markets. The second and third generations continued to grow the fortune through investment. The Davis double play was the Davis family's masterstroke. They built up a huge fortune by owning a lot of insurance stocks, including shares of Warren Buffett's Berkshire Hathaway, as well as those of many Japanese insurance companies. The Davis double play is actually quite simple. From our study of valuation, you learned that price to earning equals share price divided by earnings per share. When a company has good growth, its earnings per share goes up, and people begin to believe that the company will keep growing at the same rate in the future. This will push the company's share price higher, and so its PE will also rise. When a company's stock price rises along with its earning per share and its PE, we call it a Davis double play. And what if a company is not doing well? Conversely, both earnings per share and PE will go down at the same time. We call this a Davis double killing. Understanding the Davis double play and the Davis double killing, we can answer the first question. Should you buy an expensive stock? The answer is, you can, if under the right conditions. So, you may ask, under what conditions can I chase a stock up and buy it? I think it would have to meet these four criteria. 1. The extent of an industry's prosperity. If the industry sector of the company is booming, and the industry on the whole has big potential for continued growth, then it's pretty clear that the company will grow. Dependable growth will bring sustainable development of the industry, and it will also attract the attention of investment institutions. The outlook is even better if the industry has governmental policy support. Good examples of this are the alternative energy and semiconductor industry recently. 2. The industry ranking of the company. After finding an industry with sustainable growth, you need to figure out whether a company is a leader within that industry, because a leading company generally has a large share of its market. Its line of business is relatively stable. It has high technical and brand barriers, and it has a sustainable competitive advantage. It will not be easily beat out by competitors. 3. Excellent financial strength and continuous improvement in earnings. According to what you've learned about financial reports, this criteria is actually a reflection of companies' four main financial capabilities: profitability, potential of growth, operational capability, and solvency. Among these, you should focus on ROE. If its annual report indicates ROE is greater than 15%, it's a good company. 4. The public opinions. When a company's stock price is already high, you need to pay special attention to peripheral information surrounding them. Volatility in some markets can cause big short-term drops in stock prices, which hurts everyone. Even the best companies sometimes have public relations problems. So, when dealing with public opinion, you have to be careful what you listen to. If an opinion turns out to be just a rumor, it can be a great opportunity to pick up a bargain. From a trading perspective, even if you follow these four guidelines, I think it's best not to buy stocks that have already gone up a lot in price. Whether in the US stock market, the Chinese stock market, or the Singapore stock market, people often trade stocks based on emotion. If, after doing a detailed analysis, you do find a high-quality stock, try to wait until the price falls a bit before buying. Then buy in gradually, thereby improving the safety cushion under your average cost. Now I'll answer the second question. Isn't buying an undervalued stock a smart thing to do? Here I have to mention the valuation trap in the Davis double killing. A lot of students like to try to buy at the bottom, and if successful, they'll make huge profits. But there is a saying that trying to find the bottom of a stock is like trying to catch a falling knife. Buying a failed bottom is what we call a valuation trap. You think a stock can't fall any further, but if you don't see the stock for what it really is, you can easily fall into the market's carefully laid out trap. Generally speaking, there are 3 reasons for stock price declines. The first is getting the price of a share back to what it's really worth. The law of the stock market is that prices will always move around their true value. If the price of a quality stock goes up more than the market expects, you'll probably see some short-term profit taking. In this case, you have to analyze whether there is a problem with the company's earnings. If there's no problem with earnings and no change in the external environment, that is, if PE is reduced but earnings per share have not taken a hit, or have even continued to grow, then we might say this counts only as a Davis single killing. I should note here that if it's only the valuation that gets killed, and neither the performance nor the external environment have changed, then this could be a golden hit. And it's a good time to pick up some stock at a low price. The second reason is that something has changed in the external environment of the company. The external environment can include many factors. At the level of individual stocks, we also need to focus on the corresponding industry of a stock. When the EPS and the PE of those companies were rapidly falling, forming a Davis double killing, it was a race to the bottom, and everyone went there. If you followed, you might have lost all your money. So, when there are external environmental changes to a company, if you don't have strong macro-analytical skills, it's best to take a wait-and-see approach to stocks of this type. The third reason is that there is a problem with the company's fundamentals. The fundamentals of a company can be divided into many factors, like the financial indicators that you've learned here. If those financial indicators are getting worse, such as a sharp drop in net income, a sharp rise in the company's debt payment due to maturity, or inventory backlog, it will cause changes in its financial fundamentals. In addition to its financial metrics, things like a company's competitive environment, market share, competitors' performance, and changes in company management and all factors can affect its fundamentals. In short, if the fundamentals of a company have gotten worse, you see it in the company's performance, and eventually in its EPS. And if the Davis single kill is triggered by EPS reduction, performance will die, which will have a much bigger effect than just killing the company's share price. After all, no one wants to buy shares in a company that is not performing well and is also expensive. So, ongoing killing performance often leads to dead valuations, the result of a Davis single killing becoming a Davis double killing. A common valuation trap is when the price goes down because the performance keeps getting worse. So don't buy anything just because it's cheap. So, now you understand why buying cheap is not always a good deal, right? Okay, let's wrap up this lesson by reviewing the third trick of trading stocks, the Davis double play and the Davis double killing. A Davis double play is an increase in both EPS and in valuation, which creates a double play that rises the price of a stock. On the other hand, if EPS and valuation both drop at the same time, a Davis double killing is created, leading to a big drop in share price. Understanding these two concepts, you can all now avoid the traps of chasing highs and trying to catch bottoms. In the next lesson, I'll show you the fourth trick of trading. We will teach you the 5 market factors that can fundamentally affect stock prices. You won't want to miss it. See you next time.